28.49 USD. That is the number flashing on your screen right now. If you are checking this during the Thanksgiving holiday pause, that is the closing price from Wednesday, November 26, where SoFi Technologies finished the day up 0.16 points or 0.56% in the green. It sits just a breath away from its intraday high of 29.25, hovering in a range that would have seemed impossible to the bears just 12 months ago. The market is currently closed for the holiday, giving us a rare moment of stillness to analyze what just happened. Most investors look at a chart that has rallied nearly 85% in the last year and think the train has left the station. They see a stock nearing $29 and assume the easy money has been made, that the valuation is stretched, and that gravity is due to kick in any second. That is the expectation. The narrative on the street is that fintech had its moment in the sun, and now we are just seeing a cyclical bounce. But here's the reality that the headline scrollers are missing. We are not looking at a simple cyclical bounce. We are witnessing a fundamental repricing of what a bank can actually be in the modern economy. The reason SoFi is holding firm at $28.49, even as other high-beta tech names face volatility, is because the market is finally realizing this isn't just a lending company anymore. It is a technology platform that happens to have a bank charter attached to it. While the expectation is that higher-for-longer interest rates would crush their lending margins, the reality is that SoFi just posted its 8th consecutive quarter of GAAP profitability, delivering a record $962 million in net revenue for Q3 2025. The gap between what the skeptics thought would happen, a credit crunch collapse, and what actually happened, triple-digit net income growth, is where your opportunity lies. The tension here is palpable. You have a stock that has doubled from its lows, yet the institutional money is only just starting to position itself for the next leg up. Let's look closer at the immediate price action leading into this holiday break. Over the last 5 trading sessions, we have seen a consolidation pattern that is incredibly healthy. Typically, when a stock runs up as hard as SoFi has since the October earnings report, you expect a sharp pullback, a sell the news event. We didn't get that. Instead, we got a flag pattern. The stock pushed up to $29.25 on Wednesday, found some resistance, and settled comfortably at $28.49. Volume was solid at roughly 56 million shares, indicating that despite the holiday week, the buyers did not disappear. They stepped in to support the price. This tells you that the people holding SoFi stock right now aren't just day traders looking for a quick flip. They are accumulators. They are looking at the 52-week high of $32.73 and seeing it not as resistance, but as a magnet. The fact that the stock is refusing to break down below $28 in a shortened trading week suggests that the path of least resistance remains upward. This resilience is even more impressive when you consider the broader sector. You look at Tesla stock or Nvidia stock recently, and you see massive swings driven by sentiment and macro headlines. SoFi, however, has started to decouple from the meme stock basket it was once unfairly lumped into. It is trading less like a speculative gamble and more like a maturing financial powerhouse. When you compare the intraday movements of Apple stock, steady, methodical, volume-backed, you start to see similarities in how SoFi is behaving this month. The volatility is dampening, not because interest is fading, but because the shareholder base is rotating from shaky retail hands to steady institutional heavyweights. Now, I want you to take a second and think about your own portfolio. Are you holding this name, or are you watching from the sidelines waiting for a dip that might not come? Comment below how many shares of SoFi you currently hold, or if you are waiting for a specific price target to enter. I want to see where the sentiment is among us. To understand why this $28.49 price level is so critical, we have to look at the macroeconomic backdrop that is quietly shifting in SoFi's favor. For the last 2 years, the Federal Reserve has been the boogeyman. Rising rates were supposed to kill the refinancing business, which was SoFi's bread and butter. And to an extent, they did dampen volume. But here's the kicker. SoFi didn't die. They pivoted. They aggressively grew their deposit base to over $32 billion, lowering their cost of funding significantly. Now, as we look toward 2026, the macro winds are shifting. Global central banks are signaling rate cuts. We just saw moves from the Bank of England and signals from the Reserve Bank of South Africa and others that the tightening cycle is over. Lower rates are like rocket fuel for a company like SoFi. It means their cost to borrow money goes down, but more importantly, it reignites the demand for student loan refinancing and mortgages. The market is trying to price this in right now. That 0.16 gain on Wednesday wasn't just noise, it was the market front-running the inevitable rate cuts that will expand SoFi's net interest margin. Let's step back and talk about what this company actually does, because the online bank label is woefully inadequate. If you use Schwab Intelligent Portfolios, or if you are used to Interactive Brokers trading, you know that the legacy players have deep moats. Fidelity Investments has trillions in assets. Interactive Brokers stock trading dominates the professional active trader niche. So how does SoFi compete? They don't just compete, they absorb. SoFi operates on a financial services productivity loop strategy. They bring you in with a high-yield savings account or a student loan, and then they cross-sell you into SoFi Invest, their credit card, or their insurance products. It's the Amazon Prime model applied to banking. But the secret weapon, the part of the business that justifies the tech multiple, is the technology platform segment, comprising Galileo in Technisys. Think of Galileo as the plumbing for the entire fintech industry. When you use other investing sites or online investing apps, there's a good chance SoFi's technology is processing that transaction in the background. They are selling the picks and shovels to their own competitors. This B2B component is what separates SoFi from a Robinhood app or a SoFi robo-advisor. Robinhood Crypto and Robinhood Fractional Shares are great features, but Robinhood is primarily a B2C play. SoFi is both. They own the bank, they own the charter, and they own the tech stack that other banks use. This vertical integration allows them to iterate faster than a Fidelity brokerage or Fidelity wealth management division ever could. When Fidelity mobile app updates, it feels like a maintenance patch. When SoFi updates, they are often rolling out entirely new product verticals that integrate seamlessly because they own the underlying infrastructure. The recent earnings report from October 2025 confirmed that this strategy is working. They added over 900,000 new members in Q3 alone, bringing the total to 12.6 million. That is a staggering number. To put that in perspective, compare it to the growth rates of Fidelity ETFs or Fidelity mutual funds users. Legacy finance grows at the speed of GDP. SoFi is growing at the speed of software adoption. The financial services segment, which used to be a cash burn pit, net revenue grew 76% year over year. This is the segment that houses SoFi Invest, the credit card, and the bank accounts. It is now contributing significantly to the bottom line, proving that the cross-sell thesis isn't just a slide in a pitch deck, it's actually happening. We also need to address the elephant in the room, the crypto and alternative asset space. While Robinhood Investments and Robinhood Cash Management have leaned heavily into the crypto narrative, SoFi has taken a more measured, compliance-first approach. With the recent launch of deeper crypto capabilities and the SoFi crypto expansion mentioned in recent news, They are positioning themselves to capture the institutional wave of crypto adoption. They aren't trying to be a casino, they are trying to be the trusted bridge for the average person who wants to invest online but is terrified of FTX-style blowups. This is a subtle but crucial distinction. It appeals to the customer who might have a Fidelity IRAs account but wants a little more exposure to growth assets without leaving a regulated environment. The bear case for SoFi has always been about execution and valuation. Critics argued that a bank shouldn't trade at 40 or 50 times earnings. They argued that SoFi stocks were overpriced compared to SoFi ETFs or traditional bank stocks like JP Morgan. But that argument falls apart when you look at the growth rate. A traditional bank grows earnings at 5 to 8% a year. SoFi is growing net income at triple-digit rates. You pay a premium for that growth. Furthermore, the risk of regulation, often cited as a reason to avoid online investment platforms, has actually turned into a moat. By obtaining a national bank charter, SoFi